A bridge loan is a short-term financing tool used to cover a gap before permanent funding is secured. Think of it literally as a bridge that takes you from where you are now to where you need to be. Most bridge loans are designed to be paid off within a year, often when a property sells or permanent financing closes. Investors and homeowners use these to act quickly when they have equity in one asset but need cash for another. While a mortgage is for long-term ownership, a bridge loan prioritizes speed and short-term liquidity over low costs. The trade-off for this speed is usually a higher interest rate and significant origination fees compared to traditional bank loans. Always calculate if the speed of the transaction justifies the higher interest and fees associated with bridge financing. Bridge loans are powerful tools for specific situations. Consult with a professional to see if they fit your financial strategy.